South Africa is preparing for higher inflation. Central Africa is cutting interest rates. Those decisions arrive within hours of each other. One central bank is becoming more cautious. The other is becoming more accommodative. The question isn't which decision is better. It's why both make sense at the same time. South Africa's inflation accelerated during the second quarter, complicating the Reserve Bank's efforts to balance price stability with economic growth. Meanwhile, the Bank of Central African States lowered its benchmark interest rates, reduced reserve requirements, and projected inflation at 2.4% for 2026, below its regional targets. Those decisions point to something larger than today's headlines. Africa is no longer moving through one inflation cycle. Different regions are now responding to different inflation environments, different currencies, and different economic conditions. Monetary policy is beginning to diverge across the continent. That divergence should not be confused with industrial transformation. Lower interest rates improve financial conditions. They do not automatically expand manufacturing, finance productive businesses, or increase industrial output. Higher interest rates raise the cost of borrowing, but they do not determine whether an economy builds long-term productive capacity. The next phase of Africa's economic story will depend on something beyond today's interest rate decisions. Countries that combine stable prices with stronger manufacturing, productive investment, reliable infrastructure, and competitive industries are likely to follow very different growth paths over the next decade. Today's news is about inflation. Tomorrow's story is whether Africa's different monetary paths begin producing different economies.